Hello folks, welcome to this episode of Rich Insights. I'm Don Rich. Today's topic is on an investment strategy. We're going to talk about a covered call strategy. If you're not familiar with a covered call strategy, don't worry about it. I'm going to walk you through it. We're going to talk about what's good about it and what's bad about it. And in fact, there are a number of good things about it. I have a bad taste in my mouth though when it comes to covered calls, not because they don't have positive attributes as I mentioned. The bad taste comes from how they're sold. To use one of my father's expressions, it's like trying to find a mate that's wearing a heavy sweater. Right? It can hide a lot. And the same is true on a covered call. I just don't like the way they're sold. Again, that's not to say they don't have some positive merits. Okay, so let's get started here. What is a covered call? That's when we take an existing stock position and we're going to overlay it with a short call option. Right? The short call option is going to be written on the same stock. So now we're going to have a combination of strategies, right? A combination of positions. The long stock position and the short call. All right. It's really that simple. Now, what's good about it? What's bad about it? Let's jump into it. I want to start you off here by just starting with the long stock position here. I'm assuming that we bought this stock here at $50. So if at some future date, it trades above $50, of course, we win. Trades below $50, we lose. Now, this dotted line here, the profit diagram, is a 45-degree line, meaning for every dollar it goes up, we win dollar for dollar. Every dollar goes down, we lose dollar for dollar, right? That's it. Simple enough. Okay, let's go on. Now, the next step then is a short call. We're going to add to it. We're going to take a short call. What does that mean? So we're going to take part of the upside from our stock position. All right, we're going to take some of the upside and we're going to give it away. Why? Why would we do that? Well, because we get the option premium today. We get the surety, the guaranteed income today, right? It's an income generating strategy. That's why we would think about doing that. So there's going to be a couple main features here on this short call. Okay, first of all, it's going to be what's called the option premium. How much do I get paid to give up some of the upside? That's the option premium. In this example, remember the stock was trading at $50. I assume that we'd get $3 or so for the option. All right. Now, we got $3 for an option that was 10% out of the money. All right. That's the second key feature. The stock's trading at 50. We don't want to give up all the upside to the stock, but we'll give up any upside past 10%. Right? So 10% higher than 50 gives us a strike price. Right? That's what it's called on the option. The strike price then would be $55. Now, so those are that's the second piece of information. What's important is the option premium and the strike price. Now, obviously, the more upside we're willing to give away, the higher the option premium is going to be. So we have to keep that ratio in mind, the option premium to the strike price. That's important. Now, after that, the other thing we need to know about the option is its break-even price. All right? So the stock price can go all the way up to 55. It can have 10% appreciation, and we're fine. Any higher than 55, our profits start deteriorating. We're still making profit all the way up to 58. That's called our break-even price, right? $58. How do I come up with that? Well, it's always a strike price plus the option premium here, which we assumed was $3. Remember, so it's $55 plus 3. That gives us our break-even price. Now, after that, oh shit, right? We get unlimited downside risk. That's the problem with having a naked call. Right? You almost never want to write a short call without having the underlying stock because you have unlimited loss while your upside is capped here. All right. But we're going to have unlimited loss here. But remember, on the stock, we're going to have unlimited gain. So all we're doing is, again, we're giving away part of the huge payoff here. Okay. So there we have the basic ingredients, right? We start with the basic stock position, and we write a call option on top of that. And we need to be focused in on how much of the upside we want to give away. That's going to determine our option premium, right? That's where we're going to set the strike price at. And then it's going to affect the option premium as well. How much do we get paid to give up the upside? Well, if I don't get paid anything, why do it? But if I get paid enough that it looks attractive, well, yeah, then you should probably consider it. All right, so when you put two pieces together, the long stock, short call, you get what's called a covered call. The combined strategy is a covered call. Okay, now what's interesting here? Focus on the heavy black line, right? We still have all the information we had before. The blue line was our stock. Our brown line is our short call position, and you put them together, you mix the cocktail up, and this is what you get. Okay, first thing you notice again is the flat bar up here. The flat bar up here. This is the upside we give away. All right, so the most we can make on this trade is $8. $8. Where's that number come from? Well, our strike price was $55, and our option premium was $3. All right, so that gives us the $8. So the most we can make is, again, it goes from 50 to 58. We make the $8. If the stock price goes above $58, we end up being worse off with this strategy. All right? But from $50 to $58, that's a 16% move. Right? That's a pretty damn good move here. And anytime you're below that 16% move, you're better off. In this example, you're better off with the covered call. In fact, you're better off all the way down here to 47. Now let's think about that number. So if we just held the stock by itself, any depreciation in stock price below 50, we start losing, right? And we start losing immediately. We lose dollar for dollar. But if I receive $3 from the option premium, now I've got a buffer. I've got a 6% buffer down here. 47 to 50 is a 6% gap. So I can lose, or the stock price can fall as much as 6%, and I'm still all right with a covered call strategy. I'm still in positive to break even territory. Now below then, I face the same downside risk as the stock. Right? That is one of the important features. I face the same downside risk. I have a slight buffer. I have the option premium, yes. Right? I am generating some income, but it's not a real effective hedge because I still lose dollar for dollar, on the downside when it's below 47. Right? Before I was losing dollar for dollar below 50. Now it's 47. But I'm still losing dollar for dollar. Okay. So let's talk about, what's good about it. Let's pull the pieces together here. As I said, in this example, you could have up to a 16% profit here, all the way up to $58. So a 16% appreciation, and we're better off down to a 6% depreciation. I'm still better off with the covered call than I am just the naked stock position by itself. All right. Wow, that sounds pretty good. Now those numbers are a little inflated because I wanted you to be able to see stuff on the chart. So maybe it's not -6 to +16, pulling the parameters a little bit, but you get the idea. There are some positive aspects to a covered call. What about the negative side? Well, covered calls are normally sold on the basis of what's called a Sharpe ratio. And generally a Sharpe ratio is great. It's a great tool to have in investments, right? So let's say you're taking more risk. You're taking more risk. You think you should get a higher return, right? Otherwise you wouldn't take that additional risk. The question is, are you getting a high enough extra return? Are you getting the return you're entitled to, right? It's called a risk-adjusted return. And so by having a Sharpe ratio, we can take a whole lot of different strategies and compare them on an apples-to-apples basis to see whether or not we're getting enough additional compensation relative to the additional risk we're taking on. Okay? Now, the problem when it comes to covered calls is that they have extremely high Sharpe ratios. Okay? So remember, how's a Sharpe ratio calculated? It's your excess return from a strategy divided by your standard deviation. A standard deviation measures your risk, right? It measures the distribution of outcomes, the width of your terminal distribution. Well, if you take a big chunk of the upside, and get rid of it, it's going to make your standard deviation smaller. Well, no shit, fat man. That makes sense, right? If I give away a big chunk of my upside and I still have most of my downside, my standard deviation will still look smaller, even though it's not necessarily less risky. Because all the risk I gave up was, or most of the risk I gave up was on the upside, right? That's the problem with covered calls. I hate the way they're sold. The Sharpe ratio is not an appropriate way to look at a covered call. You have to, it gets a little complicated. You got to be talking about something like skewness or kurtosis to appropriately evaluate a covered call. Now, again, that's not to say there's not positive merits to covered calls. It is a strategy you should think about. But covered call strategies are probably more popular than they should be simply because of the way they're sold on a Sharpe ratios basis, which is misleading. All right. So that's our message for today. Hey, if you enjoyed the video, help a fat guy out, all right? I got to keep the lights on here. Please subscribe to my YouTube channel. It's called Rich Insights. Or on LinkedIn every day, we have a series of postings. We call them Fat Stackonomics. I think you'd enjoy those. So I'm Don Rich, and you just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.